So the US is very active for M&A activity. At any given time, we see between 70 to 90 active deals announced. So what happens is most investors get attracted with the large blockbuster deals that are trading at massive spreads. So for example, US Steel, Nippon Steel's acquisition of US Steel is trading at a 52% potential profit. So if the deal closes, say by the end of this year, you get to make 52% in 3.5 months. Now that becomes very attractive for people who are new to the strategy. And often what you find is people get into the strategy and they would go for the deals with the largest spreads, not fully internalizing the fact that the largest spreads also mean the largest risks, if you will.
Hello and welcome to the Achieving Alpha podcast. My name is Stephen and I am the host of the show. Today I'm delighted to be joined by Asif Suria. He is the founder of Inside Arbitrage, and in addition to that, he is also the author of the Event Driven Edge in Investing. Welcome to the podcast, Asif. Really great to have you on.
Thank you for inviting me on, Stephen. Happy to be here.
Absolute pleasure. I'm really glad that you could make it today. I'm really looking forward to a really in depth episode looking at event driven edges in investing and going through some different special scenarios and strategies. So that's going to be really great. All right. Just to get started today, because it's your very first time on the podcast, I like to give each of our podcast guests the opportunity to really introduce themselves and explain a little bit more about their background in investing and what they've been up to in their career.
Sure. So I am based in the beautiful San Francisco Bay Area in California. I've been here for the better part of 20 years. Before that, I spent about 6 years in an equally, if not even more beautiful place called Oregon. So I went there for my master's in computer science. So I have a technology background. I got started at around the time we were going through the dot-com bubble. And right after that bubble burst is when I actually started investing in 2001. So we were maybe about a year after that bubble had burst. Things were starting to look cheap, but I had no idea how far down we had to go before we would bottom. So got started, in a pretty difficult time. As I mentioned in the book, I made all the classic mistakes that beginning investors do. But I was making money in the first few weeks and months that I started investing. It was a simple momentum strategy that was working well. And then I figured there was probably something more to this whole investing thing. Maybe I should start reading financial statements. Maybe I should try to understand high quality companies. And in typical beginner fashion, I ended up picking the largest energy company in the world, the seventh largest company in the US at that time, and it was Enron, which, as most of your listeners know, turned out to be a tremendous fraud. And I bought the stock at $35 a share. By the time I decided to sell it, it was trading at 30 cents a share. So, 99% decline, if you will. And along the way, I would experience investors what they thought about it. Was Enron really in deep trouble, as the financial media was making it out to be, as the short sellers were informing us? But most investors told me to stay the course. This was the largest energy company in the world, and it'll bounce back. So that was an excellent learning experience. It was a small loss, but it taught me how to think independently. It taught me to do the real deep work that you should as an investor. You can look at multiple places for ideas, but doing your own work, there's no substitute for it. One, because it helps you identify good, high quality companies that you can stay with for several years. But more importantly, when something goes wrong, it gives you the conviction to stay with the company. You will be able to distinguish that what's going on is either because there's something not right with the company versus something not right with the market. Maybe it's the market that is overreacting, or there's fear in the market versus something that's truly wrong with the company. So deep due diligence was something that got ingrained in my brain from those early days. Started out as a value investor, for the first 8 or 9 years. Everybody reads Benjamin Graham. Everybody wants to find, a dollar worth of stock for 50 cents in the market, wait for it to get to a dollar and sell it. It's not quite as easy as buy low and sell high, as most people find out partway through their investing journey. So over time, since about 2010, I started diversifying my strategy and started focusing on what are called special situations or event-driven strategies. So you're not just putting on the hat of a value investor or a growth investor. You're looking for specific corporate events that are happening, and that becomes the source of ideas for you. And so I started with a couple of strategies. One of them is called merger arbitrage, where you buy the stock of a company after a deal is announced. For example, back then it was Oracle buying Sun Microsystems, and you could make an 8% return on the deal if the deal ended up closing. There were some concerns that Europe might try to block that deal, and that's the reason you were getting it for an 8% discount to the acquisition price. So that is one strategy, merger arbitrage, where you wait for a deal to be announced, and then if the deal is trading at a small discount, you buy it and you wait for the deal to close. I also started looking at insider transactions. Peter Lynch is famous for saying that insiders sell for all kinds of reasons, but they buy only for one, which is they think the stock is going to go up. The reality is more nuanced than that. Insiders have realized that investors like us are looking at what they're doing. And so sometimes they might actually buy the stock not because they think it's undervalued, but because they want to signal the market. And so insider transactions was another fertile area of idea generation for me. So I started tracking both these different strategies on two different websites. And then a few years ago, it must have been about 6 or 7 years ago, possibly eight, I combined them into a site called Inside Arbitrage. Started Inside Arbitrage with two strategies and over time expanded it to six different strategies. A couple of years ago, I approached Harriman House, the London based publisher, and talked to them about potentially doing a book. And one of the questions they asked me was, why do you want to write this book? And besides the fact that this was on my bucket list of things to do, I also told them that hadn't been a book about special situations or event driven strategies for nearly 2 decades, since Joel Greenblatt's You Can Be a Stock Market Genius came out. And they said, yeah, that actually makes sense. So I decided to write this book, The Event Driven Edge in Investing, with six different event driven strategies, focusing on new case studies that have occurred over the last few years. One positive case study per strategy and one negative case study where the strategy did not work out as expected.
Okay, excellent. And congratulations on your success with the book. The very interesting concept. I think it's something that is much needed. As you said, there hasn't been a book like that for a number of years. So it's great to have something that's going to educate the investors. All right. And so you mentioned part of your strategy. So you mentioned a couple of those strategies that you focus on. Could you just please outline the six different strategies that you have, maybe just a small summary of each one? And yeah, and we go from there.
Sounds good. So, as I mentioned, merger arbitrage is one of the main strategies I use for my personal portfolio, as well as something I've covered in the book. It's also called risk arbitrage because you are taking on the risk that the announced deal might not close. It might be because shareholders might not want to sell the company. It might be because regulators might step in and say that it's anti competitive for these two companies to merge. So you really are, in some sense, taking the risk and transferring that risk from regular shareholders to yourself, waiting for the deal to close. So that's merger arbitrage. Insider transactions, you're looking at both insider purchases as well as insider sales to see if it's sending some kind of signal to you. Is it one insider that's buying stock on the open market? Is it a group of them that are buying stock? Is the purchase related to maybe an options exercise? Maybe the purchase is related to a secondary offering by the company to raise more money, and they're just trying to signal confidence in the company. So, insider transactions, you look at both purchases and sales. Mostly on the purchase side is where the signal lives. The third strategy is spin-offs. So you're looking at a company to see if maybe a division that they're going to spin off is going to be very interesting in terms of both its growth prospects as well as a highly motivated team that's going to take this company and grow it over a period of time. Classic examples from way back when are McDonald's spinning off Chipotle. or Fiat Chrysler, which had Ferrari inside it, and it spun off Ferrari as an independent company. Sometimes companies might also spin things off to just leave the parent company in better shape. They might spin off what is called a bad asset and load up the spin off with a lot of debt. So you have to look at spin offs and then try to understand, do you want to buy the parent or do you want to buy the child, which is a spin off? In many cases, I've actually invested in the parent. General Electric was one of those examples where you had Larry Culp that came in after almost 2 decades of mismanagement. And one of the strategies he used to slim down the company and really turn General Electric around was to spin off a bunch of divisions. So in this one case, both the parent and the spin-off have done well, but the parent GE has done significantly better than the spin-offs. So spin-offs is another strategy I look at. And then there is a strategy called SPAC. So SPAC stands for Special Purpose Acquisition Companies. So here, what you have is a group of investors, or maybe one large investor, gets a bunch of money together. So they first raise the capital, and then they go looking for opportunities. So they go looking for an operating company to merge into, and the company essentially ends up going public through the merger with the SPAC. So instead of a traditional IPO, they go through a much faster process and go public through the SPAC. It has its own pitfalls. A lot of companies that should not be public ended up going public through the SPAC because it was so easy for them to do so. So SPACs is a really fascinating area that had its own little boom and bubble a couple of years ago. And you had the opportunity to participate in the SPAC either on the long side where you bought, before the merger was announced, or you waited, and since most of these companies were nothing more than science projects, they would drop precipitously after the merger. And so people were making money on the short side where they would sell the stock and then later on buy it for a lower price and make a profit on the other side of things. So that's four strategies. And then there is buybacks. So companies announce stock buybacks, and we look to see if this company is announcing the buyback to retire shares that were awarded as stock based compensation to employees and the management team? Or do they truly believe the company is undervalued and the market is not recognizing that this company should be trading at a much higher price? And so as a result, they go out there and start buying their own stock. So, stock buyback announcements is something we track, and we also then track to see if there is an actual reduction in the shares outstanding. Did the company go through and follow up on that announcement and go in the open market and buy stock? So, stock buybacks is another source of idea generation for us. And finally, there's management changes. There's almost nothing as important as a really good management team leading the business. Warren Buffett has a bunch of fascinating quotes about it where he talks about if a good management team meets a bad business, it's the reputation of the business that survives. But on the other hand, if it's a good management team and a good business, they can make wonders happen for your portfolio. Unfortunately, what we find is investors don't pay enough attention to management changes. And it's hard to assess how good the management might be until they've had a couple of years in their new position and to start moving the needle for the company.
Excellent. All right, that's a really good summary. I think now we can get into the weeds on each individual strategy. I'm very much looking forward to that and coming up with some actionable examples as well. First of all, I just want to ask you if we start off with merger and acquisition arbitrage. First of all, how do you assess these opportunities? So, how do you identify what these merger arbitrage opportunities are? And then, how do you assess them as part of your process?
Yeah, so the US is very active for M&A activity. So in the US, at any given time, we see between 70 to 90 active deals announced. So we created a database, and we've had this for about 14 years. And we built a tool called our merger arbitrage tool. So we load all the announced deals into this tool. And so that gives us a bird's eye view of what's going on across the entire spectrum of announced M&A activities. And then we look at every merger, and the tool basically calculates what the potential profit is between where the stock is trading right now and where the deal is supposed to close at. And it also then annualizes that. So, for example, the way most mergers work is If there aren't any significant issues with the merger, then they tend to close in 3 to 4 months. So let's say most mergers close in about 4 months, and you have a merger situation that is trading at a 4% discount to the announced acquisition price. If you were to buy that stock, the target, the company that is being acquired, and you wait to collect that 4% in 4 months, you could repeat the same process 3 times over in a year. So instead of a 4% return, you really are generating 12% returns if you can do this 2 more times that year and not taking any compounding into account. So basically, that's what we look at. We look at the annualized return. So we look at, the deal is supposed to close in 3 months or 4 months. There's a 4% spread on the deal. That means the annualized return is 12%. So to to your question, what we look at is we look at every deal, we figure out what the spread is, and we look at the annualized spread. But that's just the first high level overview of the opportunities. Then you have to dig in to understand, why does the spread exist? The market doesn't give you any free lunches, and there are no free lunches in merger arbitrage as well. Basically, every spread out there indicates that either the company is going to run into regulatory issues, or shareholders might find that the company acquiring them is not paying enough and they need to pay more, and hence they might reject the deal, which does happen very rarely. The third reason could be that they might find, for example, that the deal is in the insurance industry, or it might be in banking. And so beyond, the Federal Trade Commission or the Department of Justice getting involved for antitrust reasons, there might be industry specific regulators that might look at a deal and try to block it. And then there could be deals like a Nippon Steel trying to acquire US Steel right now. So this is a Japanese company trying to acquire one of the largest US steel companies. And considering we seem to be going through a process of deglobalization, there is a committee in the US that looks at cross-border deals. And so every once in a while, we have seen CFIUS is what it's called, the Committee for Foreign Investment in the US. They would step in and block the deal. So every deal has to be looked at to understand what the risks are and what the probability of a deal is, or whether it's going to close or not.
Yeah. Excellent. And how do you get your edge, right? So there's a lot of information in the market, and your book is called The Event Driven Edge. How do you get an edge compared with regular investors? So obviously there's a spread between the chances that the deal might not go through. What do most investors overlook, and what edge do you have when assessing those opportunities?
Yeah, so what happens is most investors get attracted with the large blockbuster deals that are trading at massive spreads. So, for example, US Steel, Nippon Steel's acquisition of US Steel is trading at a 52% potential profit. So, if the deal closes, say by the end of this year, you get to make 52% in 3.5 months. Now, that becomes very attractive for people who are new to the strategy. And often, what you find is people get into the strategy and they will go for the deals with the larger spreads, not fully internalizing the fact that the largest spreads also mean the largest risks, if you will. So there are a couple of things we do. We look at the deals with the largest spreads. I have participated in some of them, and I've had some of them that didn't work out. That's just going to happen. So you look at these and you figure out what is the best way to weight that deal in your portfolio. So think of something like the Kelly criterion for a position sizing. So you could take a very large deal with a large spread, and you could, start a smaller position size in it. You can use options. Sometimes the options premium can be so significant that even if the deal doesn't go through, you could actually end up making money. A friend of mine made good money on Spirit Airlines, where JetBlue was trying to acquire Spirit Airlines and the deal fell apart. But with the way he used an options overlay on the deal, he actually ended up making money even though the deal fell apart. So you can use options to get an edge. And then investors look at it in many different ways. Some of them might look at the preferred stock. So if the deal is going to get acquired and the preferred stock is trading at a small discount, you could end up getting the full value of the preferred stock when the deal closes. And almost no one is paying attention to what's happening to the preferred stock if the company has some of that outstanding. And then the edge really comes from diving deep into these opportunities to understand, really, understand the risks and the opportunity that might be there. A good example is Global Credit Union. It's basically a credit union that was acquiring a bank in the Pacific Northwest, First Financial Northwest. and there was a nearly 12% spread on that deal. It still hasn't closed, but there were specific conditions about a loan portfolio being sold. If a loan portfolio got sold before the deal closed, they got a certain amount of money. If not, the deal price would be reduced by a certain amount. People didn't pay enough attention to understand that even if that deal price got reduced because of this loan portfolio issue, you were still making a 10 or 12% return, almost with very little risk. So you just have to go read the deal documents, get to the specifics of the conditions that were laid out, and then you begin to understand whether this deal has inherent risks that the market is recognizing, or whether the market is making a mistake in trying to price this risk. So at the end of the day, it is your experience looking at these strategies, using them for a long period of time, and then trying to understand if you have a variant perception from the market, and sizing your bet accordingly.
Excellent. All right. Well, one of the examples I wanted to talk to you about was I've been involved in a couple of arbitrage acquisition opportunities. And I really wanted to ask you, how do you make sure? So, for example, if you have some arbitrage opportunities which close successfully, so some of my ones I'd done before was Activision Blizzard, as well as Black Knight. Don't know if you remember that acquisition. But how do you stop yourself from getting crushed by the one that doesn't go through? So you can have lots of successes and then get crushed by the one that doesn't happen to go through. And in my case, that was iRobot with Amazon.
Oh, yeah, indeed. Amazon attempting to acquire iRobot. So I was in Activision with you, Microsoft's acquisition of Activision. I was not in iRobot, and I was not in Black Knight. Not being in Black Knight was a mistake. I didn't understand the opportunity well enough, and I wasn't familiar with the company well enough to have confidence that I wanted to own it if the deal did not go through. So let's use these three examples. With iRobot, I'd looked at the company more than a decade ago. I followed it very closely, and I realized that it was a great fit for Amazon, but it wasn't a good company for me to own in case the deal did not go through. And so I don't want to get stuck with iRobot in case the deal did not go through. And so that was, just one filter initially. I had looked at Google acquiring Fitbit a few years before this, and I noticed how long it took to go through the entire regulatory process, and it looked like it was going to get blocked. So just extending that example, where Google was attempting to buy Fitbit, that deal did close, and overlaying that on Amazon and iRobot, and understanding iRobot as a company not being that strong, I decided to set that one out, even though the spread was quite large. So that was the reasoning behind that. With Activision Blizzard, the situation was amazing, where you had quite a bit of issues internal to Activision Blizzard. So they had these sexual harassment lawsuits that were going on. And the stock price had dropped, I think, from like 75, $85 all the way down to $65 around the time when the deal was announced. So Microsoft announced the deal. There wasn't a large premium that they were paying for it. And Bobby Kotick at Activision Blizzard just wanted, I guess, Microsoft's halo around the company to solve all the cultural issues that they were having. So the motivation was a little bit different for why they wanted to merge with Microsoft. So I looked at the deal. The stock price then moved up to $80 a share. The deal was for $95 and change. So stock price moved up to $80 a share. I was thinking of the deal price, and I thought maybe, if the deal doesn't go through, it drops to $65 a share. If the deal goes through, it goes to $95 a share. So at that point in time, you potentially stood to, you could take a loss of $15 if the deal didn't work out, or you could gain $15 if the deal worked out. And the probability I had assigned to the deal working out was 50 to 55%. So that wasn't a very good probability distribution for me. So what I did is I waited until the stock dropped to $75 a share. And when it dropped to 75, my downside was $10, assuming that it did drop to no lower than $65 a share if the deal broke. But my upside was $20 with a 50% probability. And so that deal was very attractive to me at $75 a share. I know Warren Buffett got in at $80 a share as well. He didn't stay through the entire process, he left. But I got in at 75. And then when it got up to 85, I sold. I didn't wait for the full process to play out, because then the probability once again had changed for me. So really, it is about you looking at the situation, You're looking at the company, you're trying to understand what happened to the company before the deal was announced. Where would this company drop to if it doesn't go through, and what's the probability the deal actually closes? So all of those were some of the things I considered for picking Activision Blizzard, but sitting out Black Knight and iRobot.
Yeah. Excellent. Yeah, sometimes the opportunities can take a long time for them to close, right? And when they go to such a level where there's not much fat left in it, sometimes it makes prudent sense to close the positions at that time, right?
It does. There are some where they've gotten very close to the deal price. There was less than a 1% spread left on it, and then something went wrong and it dropped 10 or 20%. So there are times when arbitrageurs have seen that there's very little spread left on it. We might as well just close the position and use that money and put it to work elsewhere.
Excellent. All right. Just to wrap up this section, could you give us a current opportunity in merger acquisition arbs that you're looking at the moment?
Yeah, this is a position I'm in right now. Today was the fifth or the sixth day of the FTC's lawsuit to try to block this merger. It is the acquisition of Capri, which owns the brands Michael Kors, Versace, and Jimmy Choo, by Tapestry, which owns the brands Coach, Kate Spade, and Stuart Weitzman. So this is basically two small luxury handbag shoes companies that are trying to merge, that compete with each other but also have been struggling in some sense. They were luxury brands, but they traded down to become what is now being referred by the FTC as affordable luxury, because they kept discounting their products so much that they aren't considered true luxury anymore. So when you look at LVMH, or when you look at some of the other luxury brands out there, they have multiple brands and houses under them. LVMH, I think, has 79 or 80 of them. And so Coach, which then became Tapestry, as well as Michael Kors, which then became Capri, figured they were going to adopt the same approach, and they ended up buying a few companies like Kate Spade and Versace and Jimmy Choo and all of that. And then both of them decided to merge with each other. I saw the risk of this deal being very low, which I was absolutely wrong about for the longest period of time. I just couldn't figure out why the FTC would think that two handbag companies merging with each other could cause any harm to the consumer. If anything, consumers that are looking for a luxury product are willing to pay more money for it rather than less. But the FTC had other ideas, and they decided to sue to stop this merger. So at this point in time, we are at the stage where the lawsuit has progressed, and we are at the closing part of that lawsuit. The stock was trading at about $30 a share when the lawsuit started. When the arguments in court started a few days ago, it's almost up to $40 right now. The deal price is 57, so there is still a 43% spread on this deal. And just a few days ago, the spread on the deal was almost, let's see, 92% in early August. And so it's come down from 92% profit down to 43%. So it tells you that the market, as they watch this lawsuit progress, felt that Capri and Tapestry have a good chance of winning in court against the FTC. So this is a fascinating deal. There's still a lot of profit left, but there's also a lot of risk, because in these situations, the regulators don't necessarily always act rationally. And the judge, in some cases, like we saw with JetBlue's acquisition of Spirit, everybody was surprised that after the trial played out, he voted in favor of the Department of Justice to block that deal. So I think this is a fascinating situation. There might still be a play with options because premiums are going to be very high, just like we saw with Spirit. So this is one of those deals where people who are not that familiar with either merger arbitrage or options probably don't want to touch. But the way this is different from Spirit Airlines is I track a group of seven hedge funds that focus on concentrated merger arbitrage situations. And many of those hedge funds have a position in Capri, versus almost none of them had a position in Spirit Airlines. The signal that gives you is these funds have a lot of money to have some of the best legal representation and legal minds that they can ask about the potential of the lawsuit succeeding or failing. So that is one proxy I use to see if a deal might be interesting, where some of the largest hedge funds have a position or not, versus whether they're sitting out the deal.
What's your assessment on the downside potential? So if it doesn't go through and they fail the lawsuit, you mentioned there was like a 40 something percent spread in the acquisition price. What would you say the downside was if it goes wrong?
So initially, my estimate was the downside was more like $30 or $35 a share, but that has come down quite a bit because Michael Kors has taken its eyes off the ball as this deal has progressed, and so now the downside risk is probably almost as low as $25 to $20. So what you have in this situation now at $40 is you have $15 of downside, assuming it drops to 25, and you have $17 of upside, assuming it actually closes. When it was at $30 a share just a few days ago, that was a significantly better risk reward proposition than it is right now.
Okay. All right, excellent. That's a really good example. It gives the listeners something to sink their teeth into. As we move on now to insider buying, I wanted to ask you, how do you differentiate on insider buying between people periodically taking up stock options or selling as part of a gradual plan? How do you differentiate that from key management that are actually buying the stock because they're very convicted at that current time in the company?
Absolutely. So, Stephen, we look at this data on a daily basis. Every night, we look at every filing, every insider purchase that was filed with the SEC. And then we aggregate this data and report on it in a weekly article called Insider Weekends. Every Sunday, we report on that. So when we look at this data and we clean it for reporting every morning as well as every Sunday, we eliminate any purchase that is related to options exercises. So we exclude options exercises. We exclude any purchases that might be related to an automatic dividend reinvestment. So certain companies might pay a large dividend, and insiders might have it set up automatically with a broker to buy more stock instead of getting paid that dividend in cash. So that's reported. We get rid of dividend reinvestments. We also get rid of anything that's related to a secondary offering. So the bottom line is we clean the data and we look at the true insider purchases where these insiders are buying on the open market. Every once in a while, it might look like it's a purchase, but it might be stock being moved from one account to another, and in some rare cases, from one class of shares, like a class B shares, being sold to buy a class A share. So we look at those situations as well.
Okay, that makes a lot of sense. Okay, and from what type of positions in the company gives you the best signal? So, what positions in a company are you looking at? Are you looking at when the CFO buys, or when the CEO buys, or when board of directors buy? What are the key positions where you're looking? Okay, they're seriously interested in buying their shares.
Yeah, so I'm normally interested in CEO and CFO purchases, but the problem with CEO and CFO purchases is they often buy to signal the market. So they might just be buying because they want insiders to follow their trades and get interested in the company, if you will. But if you find a chief accounting officer, a controller, a treasurer, these are people in the finance department, but not the CFO. You would assume because they are in there in the weeds with the numbers, they're generally more conservative. And if they're going in the open market and buying even more stock after being awarded a bunch of stock by the company, maybe they're seeing something in the numbers, or maybe they think that the company is going to do well in the future. So on the management side, I like a general counsel, buying, or a C, not as much CFO, but the chief accounting officer, treasurer, and a controller. So those are the positions I like a lot on the management side. On the board side, I really like independent directors who have an investing background. So they can not only understand how the company is doing, but they can understand how to value the company and how it compares to peers within the industry. So I like independent directors with an investing background that have been involved with the company for a long period of time, preferably 10 years or more. So that lets you see if they've watched the company go through the cycles. They've seen them go through a difficult recession, or they've seen them go through a bear market, and they understand how this company is positioned for the next economic cycle, or how the company is positioned when it comes out of a bear market.
Yeah, that's super interesting actually, because I think a lot of people would think from an outsider's perspective, they would think, oh, we're looking at CEOs here. We're looking at CFOs because you think, oh, they have the most knowledge about the company and they're probably the most invested in getting, you know, incentives for the stock price going up. But you're right, there's definitely some strategy at play as well. So sometimes it's probably better, as you said, for some outsiders or people that are more conservative to be buying stock as a good signal. Yeah.
Yep, yeah, absolutely. It's kind of George Soros's theory of reflexivity, where one part of the market impacts the other part, such as price impacting value, and so the same thing happens with insider transactions. Insiders understand that the investors are paying attention to their purchases.
Excellent. All right. Do you have any examples of some insider buying that's happened at the moment and it's kind of piqued your attention?
Absolutely, so many opportunities, but I'll talk about two very briefly. So there's a company called Sable Offshore. It's a offshore drilling, oil drilling company that's based right off of the shores of Southern California. So there was a pipeline leak that happened, I believe, almost 9 or 10 years ago in an offshore facility that was operated by ExxonMobil, and they decided to shut that well down, the whole drilling complex. And there was a separate pipeline company involved. Plains America was involved in taking the oil that this offshore oil rig generated and transported it to a refining facility onshore. So the whole thing got shut down after the oil leak. And more recently, a couple of years ago, there was this company that came along through a SPAC, incidentally, called Sable Offshore, that decided to buy these assets from ExxonMobil. And ExxonMobil actually lent them the money as well to buy these assets, and they have to pay ExxonMobil back over a 5-year period. And so, what they wanted to see is if they could get this whole facility to restart, if they could start producing oil in this facility and get it, shipped or use the pipeline that they also purchased and get the stuff refined. So they were going through this process of working with regulators, working with Santa Barbara County in Southern California to get this thing operational again. And a few months ago, an insider bought stock, and that made us pay attention to it and try to understand what was going on. And we realized that on early September, there was going to be a decision made, the last key decision they needed to start production by the Santa Barbara County. Sure enough, about 3 or 4 days before the decision came through, there was a fund that also bought stock. And then the following week on the Monday, they got the approval. The stock went up 40%. And that's what we outlined about 3 or 4 months ago in our Inside Weekends article, that there are two opportunities with this company. One is they get the approval from Santa Barbara County and the stock is going to go up. And then the long term opportunity, because all this oil that's just been sitting there comes online and this company could do well in the long run. So we went back and we looked at the company after that 40% jump in the stock price a couple of weeks ago, and we compared it with peers to understand how is it trading in relation to other oil producing companies. And it's trading at a significant discount to where it should be trading, because not everybody was paying attention to this approval, and not everybody had an understanding of the value this company would potentially have, but the insiders clearly did. So this was a fascinating situation where there was a short-term opportunity, high risk, high reward, and then a longer-term opportunity as production came online, and the company went from generating 27 million barrels to all the way to 80,000 barrels, 27,000 barrels, not million barrels, sorry, to 80,000 barrels per day by the year 2030.
Excellent. All right. And I heard you mention before in a previous interview something about a flip flopper strategy that happens within insider buying. For the audience who wouldn't have known what that term was before you said it, can you please just explain what that is and how it applies to this?
Yeah, so the SEC doesn't want insiders to make short-term transactions. So they don't want them to buy stock and then turn around and sell it 3 months later or 4 months later, or the other way around, sell stock and then try to buy it a few months later. So they have a rule where if an insider were to buy and sell stock within a 6-month period, they have to give any gains generated from the transaction back to the company. And so we created a screen where we look at insiders and we say, hey, are insiders buying and selling within the 6 month time frame, fully understanding that they'll actually have to give profits back to the company. And yet they're going to go ahead and do it and buy even more. So they're buying some that'll, where the profits will be given. And then we're buying even more because they just couldn't wait. The opportunity looks so good. So we created a custom screen to look at these flip floppers and see if there were these insiders that had changed their minds within a 6 month period and started buying or started selling instead.
Excellent. All right, and we'll move on now to buybacks. I wanted to first of all just get m- more of an understanding. So, obviously, the companies are buying back their shares, which they hope, in effect, that increases the share price. How do you assess the difference between a company buying back their own shares and the effectiveness of that compared with providing dividends to their clients?
Yeah, so dividends are a great way for companies to return value to their shareholders. Unfortunately, dividends do get taxed. They get taxed on the investor side, or if it is, for example, a dividend that's being paid by a real estate investment trust or certain companies that don't end up paying corporate tax, the investors end up paying even more, almost close to their regular income taxation. I'm not a tax expert, but certain kind of companies where it's a non-qualified dividend, you end up paying a significantly higher tax rate on it. So companies figured it was easier for them to, just buy back their stock. It was a more tax efficient way to return capital to shareholders. Instead of having 100 shareholders or 100 shares outstanding, if they were to buy back 20% of the company, now there are only 80 shares outstanding. So the holders of the stock, they own more of the company. And over time, either the value of the company goes up, or maybe down the road, if they declare a dividend, they could potentially declare a larger dividend. So some companies decided to start doing buybacks. In fact, the share of buybacks compared to dividends has been increasing for decades at this point, just because of how tax efficient it is. But there are other reasons for this. It's not just about the tax efficiency. It also gives the companies an opportunity to play into market psychology. As we all know, Mr. Market is delusional at times, very greedy at certain points, and then very fearful at other times. And so, if these companies see that the market is being fearful and the stock is trading at a significant discount, it gives them an opportunity to go in the open market and buy that stock back at a lower price than it should be trading. And so that's one opportunity. And then the other side of it, for whatever reason, if the stock is trading at an elevated price, maybe it became the subject of a meme stock rally, they can issue shares, they can, raise significant capital that then can be used to open new stores or open a new factory or what you will, right? So that gives them an opportunity to play into the market's delusional or the fear and greed side of things. So that's the other reason that companies might either announce buybacks or issue new shares. The third reason is often management bonuses are based on earnings per share. And if you were to reduce the number of shares, the earnings per share number automatically goes up, even if the earnings by themselves don't go up that much. So there's this other natural incentive to try to reduce the shares outstandings if their bonuses are tied to earnings per share. Um, Finally, and unfortunately, a lot of companies in the cyclical industries, near the top of the cycle, they start generating a ton of cash, and the cash is burning a hole in their pocket. They don't know what to do with it. Other companies in the industry might also be trading at an elevated valuation. So instead of going and using that money for acquisitions, or just leaving the money on the balance sheet, waiting for the cycle to turn and waiting for opportunities when you go through the down cycle, they end up announcing large buybacks at exactly the wrong time, if you will.
That was actually going to be my next question, because usually when the companies have the most money, it's usually when the company is doing well, which is correlated to the amount of money that they might have to buy back their own stocks or expand or whatever they want to do with the money that they've generated. But again, that could be when they actually are flush with their money, that could be the worst possible time when the company's doing well and the stock price is high. How do you look at that in terms of assessing companies and what they're doing with their buybacks, and are they investing at the right time?
Yeah, so what you do as an investor is you're looking at two different things. One is you're looking at management's track record at previous buybacks. Was this company buying back stock in the past at the right time? Was it issuing shares at the right time? So there's an example in the book, a case study where I mentioned Teledyne and how the CEO did an outstanding job of issuing shares to buy other companies at the right time and then turning around after the stock had dropped 80 or 90% and buying back stock. You see this happen more recently with a company called Aptiv. This was an automotive parts company that was spun out of General Motors, I believe, in 2017. And they announced a very large buyback recently where they want to buy back 25% of the shares outstanding in a $5 billion buyback. So when you look at a company like Aptiv, and so you try to understand not only what the history of this company is in terms of prior buybacks and share issuances, you're also looking to see, is this company cheap or is this at a cyclical high? And when you look at a company like Aptiv, is trading at 5 times earnings or about 6.5 times EBITDA. Not a ton of debt. It has $5 billion of net debt, but over the last 4 quarters, it also generated $1.2 billion of free cash flow. And so you look at a situation like this and you say, this makes perfect sense. I get why this company wants to buy back its stock. It's not because it's at a cyclical peak. It's not because they're trading at a elevated valuation or anything like that. This company is trading at a low valuation and it's not within a cyclical frame where it makes sense that the cycle is going to go down. So Aptiv made sense to me right now on that front. And then a few days after they announced the buyback, the CEO went and bought $2 million worth of shares on the open market. So here's your double signal, right? So you have a buyback situation and you have the insider buying. So we track these in a custom screen we call the double dipper, where we're looking at a situation where insiders are buying with their own money and the company is buying back its own stock. The thing that made Aptiv really interesting for me was out of the $5 billion buyback that they've announced, they decided to do $3 billion of that as an accelerated share repurchase. So they are going to go very quickly and use $3 billion of that buyback to start buying shares on the open market. And the fourth situation with this one thing that makes it even more interesting is there is 14% short interest in this company. So you have a situation with a short interest, the company is buying back, it's an accelerated buyback, and the CEO is buying on the open market.
Yeah, so you have the possibility of the accelerated buyback probably means that they want to buy stock as quickly as possible because they feel like it's undervalued. And then the short interest could potentially cause a short squeeze if the price goes up significantly. Yeah.
That's exactly right. So there's a potential for some short-term strong price movement in the stock, and then long-term because the company is executing well and is trading at a low valuation. There's a long-term opportunity as well, kind of like Sable Offshore that we were talking about.
Excellent. All right. Now on to spin-offs. Before we get started on spin-offs, I realized that there's different types of spin-offs, right? There's different categories. So if I'm correct, I think there's spin-offs, split-offs, and carve-out. Is that correct? Could you just explain the differences between the three?
Yeah, so before we get into that, Stephen, since we're talking about individual ideas, I also want to make sure that nothing in this podcast or discussion is investment advice. You should talk to your individual investment advisor or do your own due diligence. I'm not advising anyone to go out there and buy Sable Offshore or buy Aptiv just because I bought it or I find it fascinating.
Yeah, I agree with none of it's financial advice.
Exactly. So, coming to spin-offs, there are multiple ways spin-offs are structured. There might be something called, a regular spin-off where a company owns a division and that it gives shareholders a portion of that division through a regular spin-off, like GE did with GE's power division, or they did it with GE Healthcare. And then you have a situation where there's a fourth one called the Reverse Morris Trust where a company like Pfizer might take its generic drugs division and merge it with another company at the same time. And that makes it a tax efficient spin off situation. So, in the case of Pfizer, they took their generic drugs division and merged it with Mylan. Mylan and Teva were the two big generic drug companies at that point, and created a company called Upjohn from there, or rather Viatris, sorry. Upjohn was Pfizer's generic drugs division. So you have a reverse Morris trust. And then you have a situation, you have spin outs and split offs and carve outs. And one of the ones that comes to mind is Johnson and Johnson spun off Kenvue, and you had the option at that point in time to either retain your Johnson and Johnson shares or exchange them for Kenvue. So that's such a situation where you have to either pick the parent or the child, and you can't have both. So each of these situations are structured in a little bit different way. And so as you look at the announcements, you have to understand, is it a regular spin-off? Is it a reverse Morris trust transaction where it's going to merge into another company? Or is it a situation where you have to make a decision whether you want to keep the parent or the spin-off?
Yeah. I I've noticed that a lot of the spin-off opportunities tend to happen in either pharmaceuticals or healthcare. Is there a, obviously it does in other industries as well, but it seems to be quite focused on healthcare and pharmaceuticals. Is there any reason why these healthcare and pharmaceuticals company tend to go down this road of spin-offs? And one example I know that happened a year or maybe 2 years ago now was Bausch Health, and Bausch and Lomb was a spin-off of Bausch Health. Is there any reason why it tends to be healthcare companies?
Yeah, the large healthcare companies, as you mentioned, during their growth phase, went through the standard corporate cycle of making a lot of acquisitions. And then they become these large, bloated companies that want to slim down. And one way for them to slim down is by doing spin-offs. So the investment bankers make money on selling them ideas and companies that they should purchase, and they're going to make money on the other side when they spin off these companies and try to get back to being slimmer companies that are focused on their core business, if you will. So when you think about Bosch, that was the old Valiant Pharmaceuticals. And so it made sense for them to spin off the eye care business. And now there's some rumors that potentially the eye care business might get acquired. So it really is a situation where Pfizer realized that it wanted to focus on its R&D and on acquisitions, and it didn't need a lower margin generic drugs business. So it decided to spin that off. Or Bosch decided that the eye care business didn't make sense anymore. So it really is these companies that ended up buying a bunch of different companies, and down the road realized that they wanted to refocus on the core business and get rid of divisions that didn't make any sense anymore.
Excellent. All right. And how do you stop yourself from getting dumped on by the larger parent company where they're potentially putting all of the either assets that are in a huge amount of debt, or they have slowing sales in particular divisions? Or how do you stop yourself from getting lumbered with the bad asset?
So after the spin-off is announced, there's a bunch of information that the company releases in a Form 10 that's filed with the SEC. And they also might do investor presentations. They might have investor calls. And sometimes you get to talk to the management team to understand what's happening with this company. I got a chance to meet with Howard Hughes in San Francisco when they were here, and I got to ask them questions for an hour to try to understand the spin-off situation. It happened a couple of months ago with Seaport. So it might just be one of all of those things. You read the Form 10, you go through the investor presentations, and then you try to understand how is this deal being structured, or how is the spin-off being structured. In the case of the one where I talked about Pfizer spinning off its generic drugs division, I was actually quite interested in the deal because Mylan had been beaten down quite a bit before the spin-off, and reverse Morris trust transaction happened. But by the time it came for the spin-off to happen, we had additional information that Pfizer was going to load the spin-off up with a bunch of debt. And so at that point in time, once I figured that out and I tried to analyze the combined company, I figured it was better to invest in Pfizer instead of the spin-off. In a more recent case, entertainment, the movie and TV company, they decided to spin off Lionsgate Studios, which would have their vast library of TV shows and movies. And there, the spin off was more attractive. Even though it was going to have some debt, it had a very key part of the company, which was the movie library that generates a lot of revenue each year. So you looked at it and you realized that that asset was attractive. And strange as it seems, the management team of Lionsgate Entertainment decided to move to the spin-off Lionsgate Studios. And that helped you understand a little bit about where the value in that transaction lied, or rather lies. And what we noticed a few weeks ago was Canada's Pension Retirement Board decided to sue Lionsgate Entertainment because they felt too much of the value of the company was being transferred to Lionsgate Studios, a spin-off, instead of being retained in the parent. So you're looking at all of this information and trying to understand what is the motivation of this company to do the spin-off. Is it the spin-off or the parent that has the better assets and the better balance sheet post spin-off?
Yeah. And you've always got the opportunity as well to drop the one that's either underperforming or drop the one that has the most debt and doesn't have lots of prospects, etc. So you always have that option, right?
Absolutely. These are difficult situations to analyze, and that's the reason the opportunity exists. You have to model what the new company might look like, and not everybody might have the time or the skills to model an entire company and try to understand where the opportunity lies.
Okay, so on to management changes. And to me, this sounds like a very important area because, as you said at the beginning of the conversation, the skill of the management team really drives whether the stock is going to perform well or not in terms of the execution. First question is, how do you monitor the manager changes? Because that's quite important for people to understand how you monitor whether they're changing. And also, in which situations do you consider management changes to be positive, and which situations do you see manager changes to be negative?
Sure. So we use a number of different sources to track management changes. The primary of sources, the SEC. So we look for SEC filings every day. We have systems set up where we automatically consume SEC filings, whether it's for insider transactions, whether it's for spin-offs or management changes. And then we look at it to understand what's going on. One of the signals we look for is this management change something that's been planned for a while, or is this a sudden departure, or sudden appointment? Mostly it's sudden departures that happen. So we're looking to see, did the manager, or the CEO, the CFO, whoever it was, leave at the same time as the announcement? So that's a sudden departure, or within 30 days of the announcement. So they're not providing the company with enough time for the transition. So that might be a negative signal for us. On the appointment side, we might look to see how was the company doing before this new manager came in, and where did they come from? What's their performance at the prior company? So we track that information as well. If that's available for them at a public company, we would track that. If we see that they are somebody who have built companies up within 3 or 4 years and then tend to sell them and then move on to the next one, that gives us an idea of a time frame. Maybe this person comes in, fixes things over the first 2 or 3 years, and then decides to sell it. So really, we're looking at the track record of the manager at their prior companies, both in terms of stock performance, if it's a public company, or in terms of M&A activity that they might have engaged in the past.
Excellent. All right. What was your view on the recent appointment of the new Starbucks CEO from Chipotle? Did you think that was a good management move? Because obviously the previous CEO got fired because of past performance. I don't think the stores were growing as quickly as they were expecting. Do you see that as a positive appointment when you're assessing things?
I do see it as a positive appointment. You've seen this happen with companies like Starbucks and Disney, where you have the boomerang CEOs, the CEOs like Howard Schultz or Bob Iger, who did very well for a long period of time, handed the reins, and then had to come back in again to fix things. This time with Starbucks, it's not Howard Schultz who's coming back. He's appointed Chipotle's ex CEO. And I think this is a good move for them. I happened to be in London a few weeks ago, and I happened to go to a Starbucks there, and it was just dismal to see how it was operating. You have this all these wonderful cafes in London and Rome, and then you see the Starbucks, and you wonder why anybody is in the Starbucks. So clearly, they were, forgetting about the customer experience. They were not focused quite as much on quality. you was just saying a bunch of sugary drinks. You couldn't get a good coffee in Starbucks anymore. I don't go to a Starbucks for coffee. It's just to maybe meet somebody who knows the location, if you will. So I think this change is very good for the company. It needs a turnaround where it's not just about expansion through yet another shop down the road. It's about addressing that customer experience and coming out with a better product, if you will.
Yeah, and the CEO, the old CEO, wouldn't work past 5 p.m. as well. That probably didn't go down too well either publicly.
Indeed. And the other part of it, I'm glad you touched upon that, Stephen, because you have these situations where a new CEO comes in and they are living 2,000 miles away from the corporate headquarters and they're flying in once or twice a week. And that doesn't help build a good culture. So that's another red flag we look for.
Yeah, definitely not. All right. And do you have any other examples of management changes that are either happening at the moment or have happened in the recent history that you're looking at?
Yeah, I'll give you a recent history example and then one that's happened more recently. So the one that I talk about in the book is Larry Culp joining GE. He was at Danaher. You saw the stock price go up almost 10x during his time at Danaher, so it went up 1,000%. And so he came into GE, and you could see from the early days, the decisions he made in terms of the spin-offs. He not only just spun off different divisions of the company, he sold certain divisions to different companies. And so you could see that the capital allocation decisions he was making were very good. But these situations are large companies, and it's going to take several years for it to play out. So the point at which I got interested was about 2 years in when he made a insider purchase of GE stock. And promptly after his purchase, the stock dropped almost 30 or 40% because insiders like us value investors tend to be early in the stock. But that was the signal I was looking for. So when I saw his insider purchase, I took another look at GE and realized that he was very close to essentially just creating a company that was a aerospace and defense company with high margins and high growth. And he just had to do one more spin-off to achieve that. And that's the point at which I got interested and ended up buying the stock. It doubled from there. The spin-off, the last spin-off, which is Veronova, has also done well. So GE is one of those situations that happened a while ago that worked out well. What's happened more recently is Zillow. So there is an independent director of Zillow called Jay Hogue. I have a case study about Netflix in the book where I always track Jay Hogue's transactions very closely. He's been spot on, whether it's Netflix or Zillow in the past. And he's been on the board of these companies for 10, 15, 20 years at this point. So I saw him buy shares of Zillow on the open market a few weeks ago, and I couldn't understand what his motivation was in buying the stock. With interest rates being as high as they are in the US and in the UK, I figured the housing market wasn't necessarily going to do quite as well as somebody who might be bullish on Zillow might think. But sure enough, a few weeks after that, Rich Barton, the founder, stepped down and a new CEO was appointed. And the stock has rallied almost 30% from there. So the insider purchase a few weeks or months before that CEO change was a little bit of a signal, if you will, about Zillow's prospects going forward. And the market has reacted very favorably to the CEO appointment. So I'm curious to see how he does with Zillow in the next few years.
That's really interesting, actually, especially with someone with such a good track record of getting it right. And obviously, he's on the board, so he's obviously very close to the coal face. All right, and I wanted to ask you about. You mentioned a little bit earlier about founders that go away and then come back again as CEOs. What is your general feeling on, say, instead of them moving back and forward, what is your feeling on companies when the founder take them as far as they want to take the company and then appoint an external CEO? Because the market usually prices that in really badly, right? That the founder's taken a step back and it's not forward facing anymore. But I guess at certain points that could present an opportunity, right? Because maybe the manager has skills that the founder didn't have, and that's why they made the change.
Yeah, I personally don't, for the most part, there are always exceptions to everything, see that as a positive sign because this is a founder that created the company, got it through the first few rounds of private funding or from family or friends, or how they raised the money. They grew it to the point where the company went public. They took it through the IPO process, which is a grueling process if you went the traditional IPO route. And then you answered investor calls quarter after quarter, and you grew the company for maybe several years or decades. So clearly, you have amazing qualities to grow this company. And in some sense, it's your baby, right? It's basically what you identify with the most and you pay attention to the most. And so I really like founders operating companies. There comes a time when maybe the founder is no longer interested or is burnt out. And in that situation, the founder stepping away and an external CEO coming in might make sense. But more often than not, I see the boomerang situation where the founder comes back after a few months or years. Or you need somebody like a Satya Nadella to come into Microsoft after Steve Ballmer was appointed. So you always find this one CEO that comes in after the founder, finding it pretty difficult to take the reins and run with it. Howard Schultz wasn't really the founder of Starbucks. He got started very early on and he purchased it from the folks who were running Pete's Coffee. But in many ways, all of us think of him as a founder. And when he gave the reins over to another CEO, as we expected, he came back. So I don't see it.
The other one I was thinking of as well is Kevin Plank from Under Armour. He's come back several times as well, right?
Yes, correct. And in that case, I've been watching Under Armour, but I'm mostly watching to see if young folks in their teens and in their early 20s are wearing Under Armour at this point or not, and I haven't seen that happen yet. So that's a signal I'm looking for to see if he's going to be able to revitalize the brand and bring it back to its old glory. But I'm not holding my breath.
Yeah. He had quite a cunning plan as well with the A shares and the B shares as well to retain control as well, which I found quite interesting at the time.
Yeah, indeed.
Awesome. All right. So, for amount of time, we'll move on to the very last section now, and that is on SPACs. Probably know a little bit less about SPACs than I do the other areas because it's quite a niche area. But what I have noticed is obviously, I think it was in 2020 we saw the boom of the SPACs. I think maybe 2021 as well, when SPACs did extremely well and they were in the public eye, and there was a huge amount of SPACs that were taking place. What's caused that initial bubble in SPACs? So, for so many SPACs to happen. And then, lastly, why have we moved away from the SPAC model in recent years?
Yeah, so SPACs have been around for several years, almost more than a decade at this point. They had their moment in the sun in 2020, 2021. You had people coming out of that COVID pandemic. You had this bubble and everything. You had the meme stock rallies. And so, the SPAC bubble basically inflated because companies that wanted to go public were able to do that with very little scrutiny by investors by just merging into this entity that was a SPAC. It was a capital structure that had been raised by some investors, and you can merge into it and go public. Kind of reminds you of the reverse merger stuff that used to happen a long time ago, where Chinese companies would find a shell in the US and reverse merge into it and go public that way. And so every time you have these situations where somebody is able to go public very rapidly with very little scrutiny, it usually ends up in tears or it doesn't quite play out as people expect. But this whole SPAC situation is interesting because of the structure of the whole SPAC and warrants that go with it. So let's say a company or an investor decides to go public with the SPAC, not with the operating company. So we'll come to that later. So they go IPO with a SPAC, and so it starts trading at $10 a share. Initially, it's not shares; it's called units. So these IPOs at $10 per unit, and then a few weeks after that, I believe it's 52 days later, the units split into stock and warrants. And so you get to keep the warrants, and then you have the $10 worth of stock, if you will. And the SPAC has about 2 years to go find an operating company to merge into. And so you had SoFi, Social Finance. that went public through a SPAC. You had WeWork that tried to go public through a traditional IPO, and that did not work out. So they went public through a SPAC. You had Bolero, which was a bowling alleys company that went public through a SPAC. And then Sable Offshore, which we talked about, the ExxonMobil offshore oil production situation, that went public through a SPAC. So what happened is, the SPAC company announces a business combination where they find this operating company. They announce the merger. And at that point, the shareholders of the SPAC have the option to stick with the combined company, or they can redeem their shares. So they can say, hey, I want my $10 per share back, and I get to keep the warrants for free. And so what happened was people found this situation really fascinating where they could go buy the SPAC IPO. And when the after the business combination was announced, if they liked the combination, they would stick with it. And if they didn't like the combination, they could get their $10 back, maybe with a little bit of interest if some time has elapsed between the IPO and when they announced the combination. And they get to keep the warrants for free for the upside from the warrants. And so that's why a lot of people got interested. They started just buying the SPAC IPOs and they would redeem all the shares. So a situation happened where 90 to 94% of all the shares would end up being redeemed. And so this company that was trying to go public through a SPAC would find itself in a situation where it's public, but it has no money because everybody redeemed their shares. And so then it had to go raise money from other investors through something called a pipe offering. And so we won't get into the pipe, but that's how some of these companies ended up raising debt at the last minute at high interest rates. And so this whole situation, combined with the fact that these companies shouldn't have been going public, ended up hurting these companies, and they would see their stock prices decline quite dramatically. And this then attracted the short sellers. They looked at these companies and said, this is fertile grounds for us to go short. And because this became fertile grounds, these stocks would often end up dropping well beyond where they should have dropped. So this is where the whole situation offered opportunities both on the long side as well as the short side.
Yeah, and a lot of the SPAC mergers, they never actually went through. So they raised them and then they never ended up completing, right?
That's correct. So we see termination announcements all the time where, a merger was announced and then it gets terminated. And there are situations where they might not even find an operating company. So 2 years might elapse and they might just decide to return the money to the SPAC shareholders, along with some interest that they might have gained over those 2 years.
Okay. And last question on SPACs is, are SPACs dead now? Are we likely to see SPACs again have a reoccurrence in the future?
I don't think all SPACs are dead. There are a few that are trading above the $10 per share. So really, I think it goes back to looking at companies looking at different ways to go public, and the ones that truly should be going public might use this option, and you might not see everybody redeem their shares. Sable Offshore is a good example. When I saw that situation back before the Santa Barbara County approved this situation, there was an opportunity to participate through the warrants. The warrants were trading at $2 a share. Now they are well over $4 a share or $6 a share. So there was a way to control for the risk by buying warrants instead of buying the shares of Sable Offshore. So I think there is some potential for SPACs going forward, but it'll go back to where it was maybe 6, 7, 8 years ago, when there are just a few of these every year instead of the hundreds that we saw in 2020 and 2021.
Yeah, the hype cycle's finished. All right, excellent. So that covers the 6 different strategies that you laid out. Final question I have for you is, how can people find out more about you, and also how can people find out more about your book as well?
So the book is, on Amazon, Goodreads, The Event Driven Edge in Investing. And you can find me on insidearbitrage.com. That's my website where I have the 6 different strategies. I'm also active on Twitter under Asif Suria, as well as LinkedIn on Asif Suria. So you can either find me on Inside Arbitrage, Twitter, or LinkedIn.
Excellent. Well, I've really enjoyed the conversation today, As I've learnt a lot from the discussion. I'm sure the audience will as well, with some really good real world examples and real world experience. So I really appreciate that. And if for just for the audience, if you haven't read Asif's book already, then I suggest that you give it a good read because it's a really interesting book which covers a lot of different areas. So I'll leave the details below in the description. Um,
Thank you for having me on, Stephen. You've been a wonderful host and very knowledgeable as well. So I enjoyed the conversation.
Excellent. Thank you. I hope maybe someday in the future we can have you back on to get an update on some of those examples.
Looking forward to it.